Hi, it's Frank from CappThesis. Today we'll be looking at the S&P 500's most recent 1% decline, look at what the chances are for a bigger retracement, and at the end, we'll examine the VIX and volatility from a particular angle to give us a sense if volatility is indeed going to come back relatively soon. So let's start with this chart showing all of the 1% declines going back to April 2023. And we have in here shaded in blue here just the activity from the October low of last year. And as we know, it was the fourth 1% decline we've had since then. All of them have come in the last 4 months. We've had one in December, one in January, one in February, and now one in March. And as we can tell, they've been separated by a good amount, haven't really had clusters like we've had here between that July high and the October low, much different. And what does that tell us? It tells us we really haven't had a downside follow through. And there's various ways of looking at it. I think one in particular is very interesting, is looking at the 1% declines and realizing that there has been no follow through the next day. In fact, each one of them so far has been immediately followed by a 1% gain the very next day. So we have all of those here. We also have what the breadth looked like on those days, judging by or using the percent of S&P 500 stocks up on the day. And as we can see, there were some very bad days in there, right? December 20th, only 4% of the market was higher. On the 13th of February, which was the CPI-induced sell-off, 10%. And then you have what happened on the 5th, so yesterday, right now, and that was 35% stocks up. Not good by any means, but much more positive compared to what we've seen in the past. So one of the main reasons for this, of course, was that this was really pulled lower by technology. And so the XLK on the 5th was down almost 2.5%. 90% of its components were lower. So that means that there were a lot other sectors that actually did much better, which was able to keep this from being too much worse. And so that is really what's been the theme of late. We've talked about and heard other people mention, of course, the broadening out of this rally and seeing so many areas being able to simply hold in place as some of the bigger names have gotten hit relatively hard is an important concept and one and really a theme that we'll have to see going forward if this kind of passing of the baton of leadership, if you will, in other words, rotation, that's really what the hallmark of longer, mature uptrends is all about. And so all that has been kind of course to the market, and we've judged this by just intermittent rallies along the way. There's now been 6 of them, all between 4% and 7%, most recent one included, up about 4.5% from, again, that mid-February CPI low to the most recent high. So from this angle, still nothing to suggest anything is changed just yet. And we see that, of course, on the reverse, where the drawdowns continue to be minimal and nothing has been more than 2.5%. The reason why we keep looking at this because at some point there's going to be a change. And with every pullback and with every, bearish news item out there, there could be a chance of something to actually look different and worse, which I think could lead to some downside follow through. We're still waiting. So it's better just to be patient at this point, as it was here, of course, all the way up. Now, zooming out a bit, the rally now has gotten to almost 26%, right, from this October low. So a little more than 4 months at this point. And so that compares to the 21% move that we saw from last March's low to last July's high, and of course the 20% rally right off the low from October 2022 to that early February high in 2023. And so 20% rallies separated by some pullbacks along the way. So the question is, of course, what happens if we finally get a pullback that's meaningful? Around a correction, as we know, typically about 10%. That's what happened during these previous occasions where we had 9% pullback pretty quickly into that March low of last year, right, induced by the regional bank crisis. And then last fall, 11%, which was over 3 months. But as we know, some false moves on the upside led to even quicker moves on the downside, and that again got to almost 11%. So if we were just to put a clean 10% decline from the most recent high just this week, that would get us to right in between 4,700 and 4,600, which of course, if that happened immediately, it will create quite a sting. But at the same time, it would still be above the last high from 2023. And that would keep the big breakout intact over here as well, right? And we can also view this in a slightly different way. And we've talked about this before, frame it as an upward sloping channel, again, from the October 22 low all the way up. And within that, we've seen there's been actually 4 different up moves along the way, however you want to frame it. But as we can tell, most recent one, of course, being the longest, being the strongest. And so it continues to trade within a tighter trading range that is taking place within a much bigger one. And so again, if that pullback had come, that 10%, we said would be right around between 4,600 and 4,700. That, as of right now, would be near the bottom of this trading channel. Again, a lot of ifs, and we're still waiting for some signs of confirmation on the downside, but just to give us an idea, as we know, sometimes these come really quickly, and we'll have to keep that some perspective if and when that happens, realizing that you could take a big punch at this point because of what's happened and still be within the confines of this upward sloping channel. And so if we just look at that same line, this one here, and zoom in a bit and frame it from where it started, the S&P has now tested that uptrend line a few times and it's held. And most recently it's tested it twice now, say in the last few weeks. And so we know that even though the rally hasn't been as strong as the beginning stages, it's been consistent enough to stay within this rate of change here. And again, this is not going to hold forever. It's really what the S&P does after breaking it. Is it going to be a meandering through, or just a sideways movement for a little bit, setting up for more bullish patterns? Or is it going to be more emphatic, like we saw before, when it finally breaks, this is going to actually move lower aggressively, and we'll be looking at that as and when it happens. And so all that means, again, is that these bullish patterns can continue to work. That means that the breakout zones are being respected. And this is the most recent one. It's now about 2 weeks old, breaking through the 50-50 area, held yesterday on the 5th. Now trying to extend higher. Again, just a modest target up here, 5180. But again, if it does hit, that means we're going to have 4 straight bullish patterns work out, meaning that each breakout that we've seen, that breakout zone was not negated and the upside target was hit. When these happen over and over again, it clearly tells us we're in an uptrend. And we've said it before, we don't need each one of them to occur, but we need most of them to work out. And of course, the smallest ones have the biggest chance of being negated, only because it doesn't take that much movement to bring a breakout back down below the breakout zone. But so far, even this one continues to hold. So all of that together has helped, of course, the biggest one work out. And this was the one breaking through 4,800, which now is a number of weeks old. The S&P continues to trade above it, say 5% at the moment. And so again, the best thing about the market continuing to float higher here is that it extends further from the breakout zone, meaning that it has additional wiggle room to pull back and still keep this 6,100 target in play. And so lastly, looking at the VIX, now this again just goes back to really right before the VIX rolled over, right before the S&P 500 bottomed. What we have framed here are those 4 1% declines for the S&P, but just on the VIX chart. And so not surprisingly, when those have happened, were some of the biggest moves on a daily basis for the VIX. However, I think it's noteworthy to realize that the most recent 1% decline on March 5th coincided with the smallest gain on a 1% decline for the VIX itself, up 7%. And we see that compared to the other ones. Now, the biggest single day move we had in the VIX so far over the last 4 months was on that CPI day in the middle of February. And as you can tell here, the VIX closed in the middle of that range, where it was much higher. And so it was above 10%, but at the time we wrote a piece and looked at the last 2 times the VIX that spiked that led to additional volatility. And it always started with a VIX move of at least 15%. So for whatever reason, that really changed what volatility was doing and created additional upside volatility, which of course coincided with additional downside action in the S&P 500. So we'll get a clue here. As we talk about a lot, we think it's much more important to track the two-way volatility in terms of 1% gains or losses, but you still get some good perspective by tracking the VIX as well. That's all we have for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.